Hello everyone, and thank you for joining. So, in the last month, we saw a host of promises being made and a good deal of policies being made out through the budget of 2022. So, we are now in the post-budget phase where we are already seeing implementation of a lot of these changes, and we are also seeing the introduction of a couple of new changes. So, in this particular edition of NITYA Roundup, we'll be going through a couple of these changes, and we'll be taking you through these changes via a basket of four. Firstly, recent changes, then recent news, the analysis of Rungta Mines and Ganga International and the developing jurisprudence on transitional credits, and a couple more key rulings. We'll be concluding with a synopsis of this session and finally wind up with a live Q&A round. To begin with the recent changes, we're well aware that the budget of 2022 proposed automation of procedures for customs import of goods at concessional rate of duty rules. Now the CBIC has released a circular to be able to lay out the modus operandi of implementation of these rules. The changes proposed by Budget 22 will be made effective from March 21, 2022. Essentially, this circular lays down the transitional provisions which may be required in the implementation of these rules, and it also grants an opportunity to the importers to record details of those supplies which are already lying at their premises. Naturally, an automated procedure will lead to a simplified and contactless procedure, and end-to-end process will be made online. Secondly, the DGFT had introduced amendment in foreign trade policy of 2015-2022 in relation to script-based schemes. We've been constantly tracking the development of MEIS in India, and recently we had noticed that the IceGate portal had stopped taking applications because of the overall cap of 5,000 crores, which was the government allocation for this scheme. Now, by this amendment, the total cap of rupees 5,000 crores, which was made for the MEIS, is being done away with. Secondly, this particular notification has also extended the last date for submitting of applications for MEIS till 30th April 2022. Due dates for other schemes has also been extended. Now, to be able to increase its stronghold on the tax base, the government has also sought to reduce the threshold limit which is applicable for e-invoicing. The threshold for e-invoicing will now be the aggregate turnover of rupees 20 crores, and this change will be applicable from April 1, 2022. You can also watch our video on e-invoicing as a business reform on our YouTube channel. Moving on, the CBIC has also released post-export shipping bill conversion regulations. These regulations provide for the mechanism to amend declaration shipping bill to be able to change to any other instrument-based schemes. Such instrument-based scheme may be advance authorization, EPCG, road TEP, etc. Now, it is pertinent for us to note that these particular regulations have been introduced by use of power under Section 149 of the Customs Act. Now, the Customs Act did not have any upper limit time period to get amendment in the Bill of Entry. However, by these regulations, the department has now placed an overall cap of 1 year, which is extendable up to a maximum of 2 years for the purpose of conversion to any other instrument-based schemes. Now, these particular regulations, they also lay down additional criteria which have to be fulfilled for the purpose of conversion of shipping bill. There's one particular question which gains importance in this context for us. These regulations state that they are laying out mechanism for conversion of shipping bill to amend declaration from one instrument-based scheme to other instrument-based schemes. Now, the question relevant for us is whether regulations will also apply where no benefit was taken earlier, in other words, where there was no declaration earlier. In our view, in such cases, the taxpayers can continue to take benefit of Section 149 itself to get the Bill of Entry amendment. Moving on, several states have also come out with beneficial circulars for taxpayers, and we'll be covering a couple of them here. So, for example, the state of Maharashtra has issued clarifications on manner of dealing with following bona fide errors. So, it was the purpose stated in the circular that the government has noticed during refund scrutiny that several bona fide errors are creeping in. So they want to do away with those errors without inculcating the procedure of issuing show cause notices, etc. So it states that there may be incorrect reporting in GSTR1, which may arise due to misreporting of B2C invoices in B2B category, or typographical errors, which may lead to mismatching of numbers. The circular states that in such cases, the proper officer need not straight away take the procedure under Section 673. Instead, they may reach out to the concerned taxpayer and seek transaction-wise details, seek reconciliation. Secondly, this circular also talks about issues arising from ITC claims, as in where incorrect reporting has been done by supplier or ITC has already been reversed. In this context, this circular notes that where supplier-wise difference in ITC is more than 2.5 lakhs, in those cases, the proper officer may seek a CA certification from the said recipient, and that will itself qualify the fulfillment of criteria under Section 16. And in those cases, issuance of show cause notice may not be required. Similarly, the Delhi government has also issued indicative guidelines for issuance of show cause notice. So we often see that the show cause notices issued by the department are not in the proper format as laid out in the Act. So this circular emphasizes on this particular requirement, and it lays that strict perusal of formats and manner of issuance as provided under the law has to be done, and proper officer must provide detailed reasons with show cause notice as attachment. We often see that proper officers are only relying on the drop-down menus as provided on the portal for show cause notices. Moving on with recent news. It is expected that the CBIC will scale up departmental audits in the upcoming period to boost GST compliance. As we're already aware that the budget of 2022 sought to overcome the jurisprudence laid down by Canon India judgment, now the centre has also filed review plea against this order before the Supreme Court. The continuation of EPCG scheme is under review. And the hot topic for fintech industry as of now, tax on digital assets is expected to go up in the upcoming period, and even the GST department is contemplating applicability of GST on crypto mining and supply. The Supreme Court has laid down that state has no power to levy excise duty on wastage of liquor after distillation. And as per reports, the GST Council is comprehending revising the tax slabs as provided under GST, and the 5% tax slab may go up to 8%. Now, Deepak will take us through the several key judgments, and particularly emphasizing on the jurisprudence on transitional credits. Over to you, Deepak.
Thank you, Srishti. So, moving on analysis of Rungta Mines and Ganga International. So first, before understanding the issue, we'll discuss the poll which we run. And the question of the poll is, in your view, whether credit can be claimed for any else duty paid now, that is after implementation of GST. And such duties might be CVD, service tax, VAT, etc. And if you want, you can also type your answers in the chat box. Meanwhile, sharing the poll result, 50% of people said yes, that can be claimed, and 43% said no, and 7% was not sure. So if you see, the issue is such a delicate one and has been deliberated so much that there is confusion in the industry. And before proceeding further, I'll just take a couple of minutes to discuss what the issue is. So there is a possibility that even after implementation of GST, a taxpayer is required to pay erstwhile laws, duties under erstwhile laws. So taking an example, let us say reverse charge. There is some miss of reverse charge tax which was to be paid by the taxpayer. And when he realizes it, or let us say during department audit, he is required to pay that reverse charge. One of the audit issues recently is reverse charge on ocean freight under service tax law, which is being paid now. Other cases may be, let us say, differential duty of CVD STATE, which is being paid after implementation of GST. That may be due to non-fulfillment of export obligations or otherwise. And similarly, there may be cases wherein a supplier or a manufacturer, he has not charged excise duty or charged excise duty at a lower rate, and he is issuing supplementary invoices under GST law. So like this, there may be multiple scenarios where the supplier is required to pay the duties under erstwhile law. And the question is, because the transitional provisions do not provide specifically the fate of such duty paid, what would happen? Is there a mechanism of refund? And to that, the question, or I'll say the provision which gets attracted or attention of the taxpayers is Section 142, subsection 3. And recently, two High Court rulings dealt with this ruling, this provision. One was in the case of Rungta Mines. I'll be discussing the fact pattern of both the cases and then what they held, and also briefly discuss the way forward which the taxpayers would have in this regard. So, dealing with the fact pattern of Rungta Mines, because again, the rulings state different viewpoints, and the distinction is basically on the facts of both the cases. So, starting with the fact pattern of Rungta Mines, it procured some port services in May 2017. This is important. That was pre-GST. They procured port services. They filed ER1 without claiming credit of those port services. So again, the reason why they said they have not claimed is in the judgment it is clearly written that because they did not receive the original invoice, they did not claim credit. Then in September 2017, they received the original invoice. In September itself, 2017, they filed revised return. Now, again, if you recall the due date for filing of Tran 1, original as well as revised was extended till December 2017. And the service tax return was filed well before that time period in which they claimed this credit. Without revising the Tran 1, they filed for a refund application in June 2018. So one pertinent question is, why did they not revise Tran 1 to claim this credit? But there's no specific answer which was set forth or put forth by the department. In this, when the court, before coming to observations, noting one point here before I come to what the court says, there was an option or an opportunity with the taxpayers that he can revise his Tran 1 or take this credit in Tran 1. However, he consciously decided not to do so and therefore go to 142.3 for claiming refund. In this case, the court was very critical in its analysis of the provision section 142.3. In fact, in that context, it gave a literal interpretation because it acknowledged that taxpayer was at some flaw. So it stated that one, you cannot claim refund unless and until there is a statutory provision. It's not a constitutional or fundamental right. It's the creature of a statute. Again, the right to refund crystallizes only where the statute permits. Failure to follow procedure under 141 cannot by ISPO facto lead to a conclusion that refund is available under 142.3. Then they analyzed 142.3 and said that 142.3 would be applicable only in cases wherein refund was eligible under the erstwhile law and you are claiming it after GST. It cannot give a new right that if you have paid taxes post GST, then also refund would be allowed. In this context, they said that cash refund would not be allowed. So again, if you see the crux of this ruling, the court noted that there was an option which he was to follow. He did not follow that. And basis that they analyzed 142.3 and said, no, refund is not allowed under this provision. Now, we are dealing with another judgment. And actually, these judgments are a couple of days apart. This is the Madras High Court judgment. In this judgment, the tax was paid after implementation of GST. Therefore, the SSC never had an option to claim that credit in the service tax or excise return, and therefore he never had an option to transit it. In this specific facts, while discussing 142.3, the court said, fine, it might not be coming through the strict interpretation of the words that are used in 142.3. However, invoking the doctrine of necessity, which basically states that if, let us say, the amount is credit, it was to be eligible if paid before, but just because of absence of provisions, it is seeming that the amount would be disallowed to the SSC. So they said that applying this doctrine, you have to interpret section 142.3 to allow this. So a contradiction in that context, that they said that yes, 142.3 would be applicable specifically because taxpayer did not have any option. They remanded the matter for adjudication. Now, this is something which is also important, that they did not say that refund shall be granted in cash. They said that it shall be allowed as credit in electronic credit ledger. So, just wrapping around the matter, if let us say any taxpayer who has now paid these duties after implementation of GST, which were under erstwhile law, Firstly, they can distinguish the Rungta judgment basis the fact that taxpayer did not have an option. They can go to Madras. They can rely upon Madras High Court judgment, and just giving you an idea that before Madras High Court also there have been numerous cases, multiple cases like up to the level of tribunal and even some up to the level of commissioner appeal, which have clearly stated that refund would be eligible in this case. Now, moving on to other key rulings which have come during this period, I'll start with the ruling on refund. So, in this particular case, before the AP High Court, refund was filed after the statutory time period, and the SSC relied upon the Supreme Court order that it should be extended, the period of limitation should be excluded, and this should apply on refund claims also. The High Court accepted and said yes, the Supreme Court order, because it is overriding on all other laws, it would be applicable, and it would be applicable on refund proceedings also, and therefore refund was allowed. Another very interesting, very important case of Gujarat High Court is in fintech, and this is specifically relevant for any person who is claiming refund on by virtue of deemed exports, advance authorization, or even merchant exports. What the court acknowledged in this case is, if you, just for a briefing, if you are claiming refund of input stage, if you are not claiming any input stage benefit like advance authorization, etc., there is a provision rule 89.4. And if you are claiming these benefits, then there is a provision 89.4a and 4b. What the court noted is that while 89.4 provides a formula, the formula is missing in other two provisions. And it only says that whatever inputs are used in export, you claim refund of that. The court noted, yes, because there is separate provision, you cannot use the formula under 89.4. But because specific formula is not prescribed, use any logical basis. So in this case, they said input-output ratio for inputs would be a valid criteria to determine the value of what inputs have gone to export products. And how this ruling is relevant is because there may be similar cases, or I'll say, depending upon case to case, the taxpayer may need to dwell down, dig deep on how to compute this refund. So, any advance authorization holder or similar exporters who are claiming the refund under input stage need to make sure that the refund claim is as per Rule 89.4a 4b, because again, the portal does not provide this restriction or this option. The portal only has the formula which is under 89.4. So it is upon taxpayer to reduce that refund amount and claim a lesser refund basis these formulas. Moving forth, the next High Court ruling I'd like to discuss is upon whether hostels qualify as residential dwelling. And why this is relevant is that under service tax as well as under GST, there's an exemption from tax on services provided which are used as residential dwelling. Renting of residential dwellings basically is exempted. So the question was, because hostels, they are commercial activity in nature, whether they will qualify as residential dwellings or not. And what the court noted is they went into the meaning of the term residential dwelling, which is used for residence over a period of time. And they recognize that hostels are not someone where you go for residence overnight. It's not a shorter period of stay. Usually, hostels provide a longer period of stay, even though for students, let us say other people, etc. But it's relatively for a longer period. Basis that they held that yes, exemption would be available to them for residential dwelling. Another very important and interesting ruling comes in the form of Tata Autocom versus State of Maharashtra. And the issue is novel because in Maharashtra, Gujarat, there is a demand or there is a levy of stamp duty which is coming through circular when you are filing a bill of entry. And this, of course, becomes a cost for the SSC. There is no credit mechanism available for that. For this, when the Tata company approached the High Court, they state the levy of the stamp duty. They relied on the Gujarat High Court judgment in the case of Reliance Industries and said which had quashed the levy. And they noted that when against Gujarat High Court, the state of Gujarat went to Supreme Court, they have admitted the appeal but did not grant stay. So in this case, they have granted a stay that no stamp duty needs to be paid in this case. But yes, this forms a very important and an interesting issue for wherever stamp duties is being chargeable or is being paid on imported goods. Now, another ruling, this ruling is of Supreme Court of Service Tax Law. So we'll be discussing that. A very important ruling which distinguishes between the meaning or scope of job work and manpower recruitment supply. So in this case, assessee was basically arguing that he's providing a job work service and therefore he's exempt. So serial number 30 of the exemption notification exempted that. The court noted, the tribunal also was against that it is not a job work, it is a manpower supply. The Supreme Court also noted that if you see the contract terms, it does not prescribe or it does not have the essence of job work. It is artificially designed or attempt is made to artificially cover it under job work. But if you see the responsibility of job work undertaking the services, his responsibility vis-a-vis quality, quantity, etc., that is not there. So they held it is nothing but that of a supply of labor and therefore not exempt under service tax. Now moving forth to advanced rulings which have come in this time in recent months. A very interesting, important and a different ruling which has come is of Golden Toby, wherein the assessee was supplying 30 free products along with 100 products. So he was a cigarette manufacturer dealer. He was supplying 30 cigarettes along with 100 cigarettes. So the question was whether this is a free supply or not. So the AAR, it relied upon circulars that had come and it noted that buy one get one is not an individual supply and free supply. It is in fact multiple supplies being made for a single price. Now this is something which the circulars also said, and of course nothing new in that respect. But the next point is important. It said that the taxability would depend upon the composite supply or mixed supply consent. And in this context, because the same product was given, it said no additional tax liability will be there. So two important points which come out of this advance ruling is, point number one, when the same goods are given as free, it would not make a difference because of course there would be a composite supply or single supply or a reduced price. But a discussion or a distinction would come. And these concepts of composite supply and mixed supply would hold relevance when two separate items are being supplied. So let us say along with a fridge, you are supplying a TV. Two separate items, one you would need to see how would you categorize that. Secondly, towards the later part of the ruling, the AAR has also discussed whether in case of related party or stock transfer, it would make any difference. And they have sought or relied upon the declaration of the taxpayer that the dealers are not related persons. So in this context also, I was not very sure of how this would be of relevance. Even if they were related person, the concept would be same. But yes, they have said that advance ruling would not apply in case the dealer is a related person. Sorry. Moving on to another ruling of AAR. Actually, a bit, I'll say, incorrect ruling. They have said when you are determining the time limit of availing ITC, you see when it uses the word September or annual return of the financial year to which such invoice or debit note pertains. So they have said it would mean that it would when the supply is made and not the document date. So in that context, why it is tricky is because if you see even now the amendment which has been made for debit note, it is clearly stating or it is clearly reflective of the fact that they are considering document date and not the supply date. Also, this would be relevant for cases wherein, let us say in case of reverse tax transaction, there is a delayed levy or delayed payment of tax. So let us say for reverse charge, the levy was in year 1, but you are making payment in year 4. If you see the relevant date of document as the invoice or self-invoice, then the credit can be availed in year 4. But if you apply for adopt this advance ruling, then credit cannot be available. So in our view, this advance ruling is incorrect because it misses the point that you have to see the document date and not the supply date. Moving forward on next advance rulings, this deals with ITC on medical expenses, medical insurance services. The peculiar fact in this case was that it was the assessee was claiming ITC for medical insurance, which was taken during the period when medical insurance was mandated by MHA. So during COVID period, initially what happened was there was a brief period wherein MHA mandated that you have to claim insurance for your employees. And for this period, insurance claimed that SECI had requested for ITC eligibility. Unfortunately, what the advance ruling noted or discussed is the provision that because he's neither a supplier of healthcare services, not a part of a composite output supply, therefore ITC would not be available. However, they did not discuss the provision which says an exception to this provision, which says that if it is mandated by law, ITC should be available. So, in our view, because that provision was not considered, and applying that provision, ITC should actually be available on medical services for the period where it was mandated by MHA. Ruling from this ITC rulings to the ruling on classification advance ruling which was pronounced. In this particular case, the SECI was requesting classification of driver cab air conditioning unit, and which was designed solely as per specification of railways, was meant solely for use in railways, and the department held that they will be classifiable as parts in tramways, locomotive, and running stock. And the difference in this is that the GST rate on AC and this is different. And again, the dispute, I'll say, keeps continuing whether the group classification theory, which was brought in by Westinghouse, subsequently distinguished by circular, whether that would apply, or a specific coverage of air conditioner unit that would apply. So this dispute, I'll say, multiple advance ruling, multiple court rulings have come on this respect, and it is expected that the dispute would continue in some time more. So moving forward to the synopsis of what all we discussed in today's session. So we discussed the refund of pre-GST taxes paid post July 17, like CVD, SAT, reverse charge, etc., should be allowed as refund basis the doctrine of necessity, which was discussed by Madras High Court. We discussed that Supreme Court's order on an extension would apply to refund claim as well, as was held by the AP High Court. We discussed that the stamp duty on bill of entry as is being leveled in Gujarat, in Maharashtra, is under challenge. And you already have a positive High Court ruling in Gujarat. Another High Court ruling which we discussed, and an interesting issue was that for refund in case of advance authorization, EOU procurements, etc., if you are claiming that input stage benefit, the input stage refund then can only be done based on a reasonable formula. And it cannot be done based on the turnover ratio provided under 89.4. Next, we discussed that even if goods are given free, they are not free and they form part of the composite. They form part of the main supply, and principles of composite and mixed supply may become relevant. Again, an interesting advance ruling which has come, which has, I'll say, distinguished from the trend which were coming on these rulings earlier, and a very interesting one in that context. We discussed the recent changes that have come for e-invoicing that has been reduced to 20 crores. And then IGSER rules automation is in procedure, and a circular has been issued clarifying several aspects. So, thank you everyone. Thank you for giving us this opportunity. Thank you for your time.